On the Express this week, it's Tariff-a-palooza and everyone's going to pay. And then there's copper. Why is the stock market unfazed by all of this? We'll talk about that when Callie Cox of Ritholtz Wealth drops in for a few good minutes. And can Nvidia get to $10 trillion in market cap? We'll explore that, plus the Investopedia indicator and what to expect this week. Ticket to ride on the rails to progress. This train goes express. Welcome back and welcome aboard to the Investopedia Express live from the New York Stock Exchange. It's a Monday morning. It's humid out there and markets are a little softer, a little choppy, given all the tariff news from last week and over the weekend. We'll dig into that in a minute. Top stories now on Investopedia. We're looking at the stock market. We're looking at the new trade policy and the tariff announcements on the EU, Mexico, and Canada announced last week. Plus, we're looking at what to expect from earnings season. Earnings season starts this week. This is going to be a big one, and we'll hear from companies starting with Fastenal this week. We'll get into the calendar, but this is make or break for so many different companies this week. Plus, Bitcoin setting another record high, $122,000 per Bitcoin, the price nearly doubling in the past year. Smart story on that on Investopedia.com, and also why beef prices keep rising to new highs everywhere. It's a bubble up across asset classes. Stock market still within 1 or 2% of record highs despite all the choppiness, but it's all about tariffs and new tariff announcements, and those started rolling in last week. Let's bring you up to speed with the very latest. 30% tariffs on the EU and Mexico announced by the Trump administration. We have additional tariffs on other countries last week, including Japan, South Korea, Canada, and Brazil, plus a 50% tariff on all copper imports. We're going to get into the importance of Dr. Copper in just a couple of minutes. Also, 25% tariffs on South Korea and Japan, a potential 35% blanket tariff on Canadian goods. We thought there were negotiations underway there. Those don't look very strong at the moment. But also, we have massive tariffs and blanket tariffs potentially against countries we haven't even heard from. We haven't heard a lot from China lately. That's obviously a big trade partner. And when it all comes down to is what are we importing into this country, what's getting the tariff, and where are the reciprocal tariffs? And as a country, we import about $4.14 trillion worth of goods. As of last year, we export $3.23 trillion. There's your trade deficit right there, $900 billion. That's what this administration is trying to close up, and it wants countries to pay for the privilege of selling their products into U.S. consumers. And what are we talking about? Capital goods. What are capital goods? Capital goods are machinery, equipment, industrial materials. That's our biggest import source. Consumer goods, that's next. Toys, shoes, apparel, iPhones, headphones, just about everything we use that's electronic these days. Industrial supplies, that's a big one as well. Automotive vehicles, we know there's a 25% tariff on cars and automobiles made outside the U.S., but that's one of our biggest sources of import, but also so many car components of cars that are made here in the U.S., those have tariffs on them as well. And then there's food and beverages, and that's where the European tariffs and the Mexican tariffs and also the Canadian tariffs hit the most. So Tariff-a-palooza will probably hear more this week. But the big one last week that, well, I think a lot of people took notice of, especially those that follow the commodity sector, is copper. Paging Dr. Copper.
Then there's copper, which is the only pipe I use. It costs money. It costs money because it saves money.
Oh, Cosmo, who can forget that line? There is only one copper, one Dr. Copper out there, and there's a reason that commodity traders and investors at large follow the copper market. We use it in just about everything we make. We use it in almost every single industrial and mechanical component, and it's about to get 50% more expensive. Now, as a country, the U.S. produces a fair amount of copper. We produce copper in places like Arizona, New Mexico, where I'm from, Utah, and Colorado, but we import a lot more than we use. So when these copper tariffs begin, and those are going to start August 1st, unless something changes, we're going to see a price spike across the the industrial and electronic spectrum. Let's take a quick look at where we use copper. Well, we know that a lot of it is coming out of places like Chile. We know a lot of it's coming out of the Congo, 50% of it coming out of countries outside the U.S., with Australia a big miner of it, the Republic of Congo. Russia is a big exporter of copper as well, but Chile is the biggest one. If you've ever read The Fountainhead, you know that copper looms large in South America. But when we think about where we use it, copper is just about everywhere in our manufacturing and industrial ecosystems. It goes into electrical appliances and wiring. It goes into power generation and transmission, electronics and telecommunications. EVs rely heavily on copper, especially for batteries, but also for a lot of the other components that go into electric vehicles. And we know a lot of those incentives were pulled when that big, beautiful tax bill passed a week plus ago. Plumbing and water systems, HVAC, data centers, copper nearly everywhere you look. And we're going to need a lot more of it. Now, why is this happening? The president and this administration wants more copper production here in the United States, and they're pushing companies to mine for more copper. But there's also been some blockages of copper mining exploration deals over the past several years. We might see some of those go through. In terms of who are the biggest U.S.-based copper manufacturers, well, look no further than Freeport McMoran. This is a huge company out of Arizona. They have huge gold and silver mining operations, and also Southern Copper Corporation, pretty big in Arizona. They're also big gold miners out there. Somebody knew this was coming. The president did allude to the fact that there would be tariffs on copper imports a few months ago. And if you've watched the copper trade closely, that took off like a rocket last week. Somebody knew that we were going to probably see an announcement last week about these copper tariffs. They were right. And somebody who was betting on those stocks also made the right bet. Those stocks plus outside copper producers, the BHP Billotons, the Rio Tintos of the world, those have seen a nice price spike over the last several weeks, as a lot of people have seen this copper tariff coming. So here we are, more tariffs announced last week. We'll probably get more tariff announcements this week. There's only been about 2 or 3 big deals with our trading partners. One of those, obviously, with the UK, and another one with Vietnam. But in terms of the big ones, we're talking about China, of course, Canada and Mexico. We have not seen any news except for the announcement of those tariffs last week, and then promises of potential reciprocal tariffs from those countries. And that's why you see a little choppiness in the market, but we're still dancing around all-time highs. And we still believe, if you listen to what investors are telling us by what they're buying and selling, or you listen to institutional investors, it's been America or bust. I want to get into that with our good friend, Callie Cox, the Chief Market Strategist of Ritholtz Wealth. She joins us for the drop-in. So good to see you, my friend. Welcome back to the Express. So good to have you on the show.
Yeah, Caleb, thanks for having me. Lots to talk about this morning.
Yeah, well, I'm an avid reader of your Substack and your posts on the Business Insider. I love your charts. I love the work that you do. Been a big follower and fan for so many years. And you got this recent post on the Business Insider. Also, it's on Optimistically. We'll link to those in the show notes about U.S. exceptionalism, right? We're the biggest stock market in the world. We have the biggest share of global GDP at 27%, yet only 4% of the population. And amid all of this economic chaos, all of the tariff talk, U.S. stock market, again, near record highs. What do you make of it? How do you explain this to your followers and the clients of Ritholtz?
Well, how much time do you have here? I think where I'm struggling right now is, and I think a lot of people are struggling with the same thing, is the nuance you have to consider when the U.S. is under so much economic pressure. But at the same time, you're right. It's far and away still the best country to invest in if you look at the most innovative companies and the fattest profit margins you can find around the world. So, that post was kind of picking apart the reasons why I'm still investing in the U.S. My personal portfolio is a majority U.S. equities. I could say that for Ritholtz as well in their core models. But it's really important to be measured in this, and to remember that you don't have to be black and white in your positioning. You don't have to be all in on the U.S. or all out. I think that's especially important this year.
Yeah, and we've seen through the first few months of the year, every market but the U.S. was rallying. We saw the best performing stock market in the world was Poland. We had huge rallies in places like Chile, which I just mentioned, of course, Colombia, Mexico, even Brazil. And now these countries are getting slapped with some tariffs. So the pendulum does swing. It's rare to have countries outside the U.S. outperform the United States stock market because we have so much money in this market. American exceptionalism continues even amid the economic uncertainty. You also noted this in a recent post. More record highs. We've had about, I think, 6 or 7 so far this year, but last year we had something like 57 or so. More record highs and fewer crashes. And even the crashes that we have, Callie, as you know this, they go by very quickly. Now, some of that, and you wrote about it again in your recent post over the weekend, is because sometimes when we have a crisis in this country, like the great financial crisis or COVID, the government just showers money, whether it's flooring of interest rates or giving money to people through stimulus checks. That's not what's happened this time around. We've just had headlines bouncing around, and we don't know actually where the political certainty is. But this notion of more and more record highs and fewer, smaller, quicker crashes, that's an interesting picture for investors to be invested in. What do you make of it?
Yeah, it's one of the things I think about a lot. And, you alluded to political uncertainty. I think that's the biggest thing to watch here. I mean, you were speaking about the tariffs a few minutes earlier. We have 51 new tariff threats on countries all around the world. 10 to 15 of them are top 15 trading partners, which is what I would focus on, just to keep yourself sane because all this noise is a lot. Take it from me. But I think what you have to remember is, we're in a place where there's a lot of economic pressure. The Fed can't step in and lower rates quite yet because the Fed's hands are tied. Their job is to promote healthy price growth, stable inflation, and to promote maximum employment. And both of those sides of their job are at risk right now. So going back to the stock market, there's a lot of pressure, a lot of uncertainty. And you have some government policy movement. Obviously, we had the OBBBA. That isn't as much of a boon to growth as I think some people make it out to be. And at the same time, the Fed can't really step in. So, again, I don't think you invest around crashes. Of course, that's market timing, and nobody wants to, get into the game of market timing. But as an investor, what you need to do is learn how to stay invested while being rational, being measured, understanding where you can make some bad decisions and crashes are when that can happen. So it's best to understand what the risks are and how you're putting your portfolio at risk.
Yeah, for a lot of people, and I have a couple of young daughters, 21 and 19, but I talk to their friends a lot, and there's this disbelief in this entire structure, the capital markets. Like, why does it even work this way? Why does the stock market average a 10% gain every single year? Now, not every single year, but an average 10% a year. Why does that keep happening? Why does it keep going up and to the right? And Ritholtz Wealth and your friends over there, Michael Batnick and others, have created an awesome chart of all the different things that have happened over the last 30 to 40 years that should have thrown the stock market into deep turmoil. Guess what? It recovers. So how do you explain to young people the premise of this is just going to work out eventually?
Well, I get it. I grew up in the Occupy Wall Street generation. I have these conversations with my friends and family all the time. It is a crazy thing to wrap your mind around, especially because it includes having to understand compounding interest. And look, our brains are not wired to, think exponentially. But it goes back to what we were talking about before, Caleb, the American exceptionalism, the glut of money that's come into America, the fact that we've built the most innovative companies with the fattest profit margins. And, to boil it all down, we live in a capitalistic society that encourages humans to think outside the box and to really, get back up after they've been pushed down. So the stock market has a lot of rich history under it. I understand why people are skeptical. The great financial crisis was a thing. The financial industry is not the most trustworthy industry to, listen to. And I think about that all the time being a member of it. But, if you're in your 20s, if you're in your 30s, if you're investing for retirement or to build wealth over decades, the stock market is still the best vehicle to look at. It is one of the biggest markets in the world. The American markets are the deepest and most liquid markets you can invest in. So I don't think you can ignore it, but you can certainly invest in it and, be vocal about the change you want to see while pulling in some alternatives as well. I mean, if you're a 20-year-old and you want to learn more about the world of crypto, go for it. Understand the risks, but go for it.
Yeah, it's going to be a lot more prevalent in our lives. Yeah, Slate FO commenting that most predicted economic doom when Trump insisted on tariffs, but to date, nothing. More smoke and fire. We'll see if that lasts because the market keeps bouncing back and finding a way. When we're talking about the market, we're not talking about this mysterious thing or these men and women running around in weird shirts down here. We're talking about investors at large, institutions, big institutions, but investors like us who do the same thing basically every couple of weeks. I talk to your colleague Josh Brown all the time about this, the relentless bid, right? Every 2 weeks we do the same thing. We buy through our 401ks or our IRAs or our Roth IRAs. A lot of us buy the same index funds, and those index funds are so heavily concentrated with the biggest tech stocks out there. We're going to talk about Nvidia in a minute, hitting the $4 trillion mark. Do you worry as a strategist about this extra over concentration of the biggest tech stocks that control most of the market cap and most of the movement in the indexes? Or is this just another manifestation of what we saw with big oil in the 70s, telecom in the 80s, the PC industry in the 90s, and internet stocks in the late 90s, early 2000s?
So I think you can answer this two ways. First of all, yes, the market is becoming over concentrated in tech, especially when you look at the market. If you look at tech shares as a percent of market value versus the net income they bring to the table, which is the chart you're seeing right here. I want to be very clear. It's okay for investors to dream about AI. AI is a compelling story. And this gap between text representation in the market and representation in income is happening because investors are bullish on AI. That's okay. The other thing that you alluded to, Caleb, is there are so many investors, a lot that I'm probably talking to right now that invest in 401ks, that invest in index funds, that simply attach your portfolio to the makeup of the market. And if tech is one of the biggest industries out there, then naturally you're going to be over invested in tech, and that money is going to be added disproportionately to tech. I don't think that latter trend is ending anytime soon. I think it's a very important reason for investors to know what they're invested in. And hey, if you're contributing to a 401k, you're investing, congratulations. But on the other hand, if you're a more active investor, if you're trying to take a sector view in your portfolio, I think it makes sense to maybe cut down on tech a little here because we've seen a lot of dreaming in that sector. And we don't know if that continues, especially with so much economic pressure on the job market, tariff uncertainty. By the way, tech is one of the most exposed sectors globally in terms of revenue and cost of goods. You don't necessarily have to get in or out, going back to that tendency to think black and white with things. We're just talking about cutting back on your profits a little bit, rotating them into more unloved sectors, trying to keep your portfolio balanced in case anything bad happens.
And then there's the big D, dividends, which I know as a longtime investor and student of the market. This is that extra sauce we get for the privilege of investing in these companies. They pay us a little bonus. So buying companies with dividends and leaning into your strategy, that produces so much extra cash that I don't think most investors are aware of. Give us the Callie Cox basic fundamentals of why dividends are so important.
Well, you explained it right there, Caleb. You get paid a flat fee, either in shares or in cash, just for the privilege, or sorry, just for the obligation, or whatever the word is, just because you own the stock. Of course, you can get a little picky with this. If you're a younger investor and you're bringing in dividends through your investments, that's probably not the best way to go from a tax perspective. But dividends are this overlooked part of the market that are really important, especially if you're an income-focused investor and you like getting those checks month after month, and they add up over time. I mean, I pulled this stat in a newsletter about a month ago, but if you've invested over the past 30 years or so, dividend growth, in an S&P 500 portfolio, to be clear, dividend growth has made up almost 50% of your market gains because, again, going back to compounding, it's like a snowball effect. $10 in dividends reinvested in your portfolio can look like, $20 a year down the line. So, think about dividends. Don't overlook them. I think dividends are a little bit harder in this environment, and to the audience I'm talking to. If you are a little bit younger, if you don't need that income month after month, then yeah, you could probably pass on them. But don't forget about them. They become more and more important as you get closer to your goals.
Absolutely. And they're just part of the fundamental basis and foundation you need to be a smart investor. And that's what you are. And you are such a great educator as well. Folks, we will link to Callie's awesome newsletter in the show notes as well. But please follow her, Callie A. Boast, across all platforms. Callie Cox, the Chief Market Strategist at Ritholtz Wealth, and a good friend of mine and Investopedia. Thanks so much for coming back on the program. Good to see you, my friend.
Yeah, thanks for having me.
All right, let's rock a little money in motion, because money was in motion last week and continues to flow towards Nvidia, which became the first company to reach $4 trillion in market cap. Now, for folks that aren't familiar with what that means, it's not that Nvidia makes $4 trillion. The market cap or the market value refers to Nvidia's share price times the amount of shares outstanding the company has issued over time. And Nvidia has issued about 25.4 billion shares over time. Well, they've split many times, so that's how you get to 25.4 billion. But it's one of the most widely held stocks in the world. Stock has split again several times over the past few years, but it didn't just get here. The company went public in 1999, like a bunch of other companies, and its path from 4 trillion to 5 trillion, 8 trillion, 10 trillion doesn't seem crazy when you look at what got it here and what the next phases of growth might be. Let's dig into it a little bit. Okay, it's the first company that got to $4 trillion, beating Microsoft, beating Apple, these big behemoths that have been around a lot longer than Nvidia. So there's a chart there, and especially over the past few years. Now, why has this happened? Nvidia and the CEO, Jensen Huang, I think we have a picture of him in the early 90s. He's still there. He is sitting in his office in the early days of Nvidia. Well, he's transformed as well, but he has put Nvidia in the right place at the right time. Look at that transformation. Look at that, from humble button up to the all important black leather motorcycle jacket that he wears constantly. Jensen Huang has become the celebrity CEO of the moment, but he's put Nvidia in the right places at the right time. At first, that was creating GPUs, processors for gaming consoles, right? And then it was creating GPUs or chips for cryptocurrency mining. You need a lot of computing power to mine cryptocurrency. And Nvidia was in the sweet spot when cryptocurrency had one of its major rallies over the past decade. And then putting chips into AI functionality, creating really smart, super strong, very fast chips for the AI revolution. That's how it got to 4 trillion, but it took 24 years to get to $1 trillion in market cap. It only took 2 years for it to get to $3 trillion in market cap, and then about a year and a half to get to 4 trillion. So where does it go from here? Well, you got to think about what's next in the AI revolution. And if you remember our conversation with Dan Ives a few weeks ago, he thinks we're in the second inning of this. And as we have what we call superscalers, companies like Microsoft, Oracle, Salesforce, Apple, Amazon, Meta, all of them trying to own as much of the AI universe as possible and spending tens of billions of dollars on chips and the build out. Nvidia has 90% market share in AI chips. And if we're only in the second inning, and the next phase of this is generative AI, agent-powered AI, having AI robots clean your home, do your laundry, take your kids to school, right? If you think about where this is going, and robotics in general, and AI has that kind of market dominance, not crazy to see it going from 4 trillion to 5 trillion. That's a 20% rise. Could it go from 5 to 10 trillion? Will we see multiple companies in the 4, 5, 6 trillion dollar area? I think we will, because these are the biggest companies in the world. Investors flock to these companies, and the more they buy their shares, and the more shares they have outstanding, the larger their market caps go. That's how you get to 4 trillion, 5 trillion, and beyond. We live in the land of giants, and that will only stay the same and not get bigger over the next few years. And people have asked us this at Investopedia all the time. Should I buy Nvidia at these highs? It's a $4 trillion company. Should I buy the stock market when it's at a record high? Well, the fact of the matter is record highs are an indication that things are going pretty well for the stock market. It's the most bullish sign you could see. So a lot of people ask in general, the stock market's at record highs. Should I be buying it now? It seems really expensive. There's a lot of risks out there. There are always a lot of risks out there. And in fact, we have a not so legible chart from JP Morgan that does a great research deck every year, really surrounding the whole market. Investing at all-time highs actually delivers better returns than investing when the market's not at a record high. So if you choose not to invest because you're worried that the market might be priced out, might be too high for you, just remember this chart. 81% of the time, if you invested at a new high, the stock market went on to make new highs after that, and your returns are much better than if you invest on days that are not at a record high. We always say this at Investopedia. Best day to start investing, yesterday. The next best day is today. All right, let's look down the tracks a little bit to what to expect on this very busy week. We got the beginning of earnings season. Second quarter earnings season really begins today with Fastenal, the first company to report results. But then we're going to hear from the big banks at the end of this week. But this is a huge week for cryptocurrency. They're calling it Crypto Week in Washington. Why? Because we're going to see votes and probably the passage of the Genius Act that regulates the issuance of stable coins by financial institutions. Want to know why Bitcoin is at a record high at 122,000 per coin as of this morning? It is Crypto Week in America. We're also going to see the passage of other acts or bills, including the Digital Asset Market Clarity Act. That gives new rules to the CFTC, the Commodity Futures Trading Commission, and the SEC to regulate digital tokens. Remember, the SEC had wanted nothing to do with cryptocurrency under the previous administration. Now they are all in. Also, the Anti-CBDC Surveillance State Act, so clever with the naming of these bills in Washington, that forbids the Federal Reserve from creating its own digital currency. Very interesting space to watch this week. Crypto Week in America. That's why you see Bitcoin at record highs. Tomorrow, Tuesday, the Consumer Price Index for June rolls in. Prices have remained pretty stable because we really didn't have tariffs. We had just the threat of tariffs. We'll keep a close eye on that. And then the big bank earnings start with JP Morgan, BlackRock, Citigroup, Wells Fargo on Tuesday. Wednesday, PPI following CPI, the Producer Price Index, earnings from J&J, Bank of America, Goldman Sachs, and United Airlines. Hey, we started to hear guidance from the airlines last week when Delta said things will look a little bit better for the third quarter. They're going to give us some guidance going forward on what revenue looks like, revenue per passenger. Keep a close eye on that. Thursday, we'll get retail sales, earnings from Taiwan Semiconductor, the biggest chip maker in the world, Netflix and PepsiCo. And on Friday, housing starts for June. Nobody's really starting new housing right now. We still have mortgage rates over 6.5%, earnings from 3M and American Express, among others. So it is going to be a very busy week and time to buckle in. What indicator are we looking at this week? We're looking at dividends. You heard us talking about it with Callie Cox. Dividend payouts are a huge bonus to investors who get that little kick out every quarter for owning the stock. And if you hadn't noticed lately, dividend by companies, those have been kind of getting lowered. Those have been getting reduced over the last, I would say, few decades. Companies are still paying dividends, and when times are good, they increase their dividends. But really, since the 1970s and 80s, when we had the big oil majors and the GEs of the world, and start in the beginning of the big telecom companies, dividend payouts have been going lower, and we're getting less of an incentive and a bonus for owning these stocks. So in this earnings season, which really begins today and extends for the next 3 to 4 weeks, I want us all to listen very closely to what companies are saying about dividends. Are they increasing their dividend? Are they reducing their dividend? Are they going to make any adjustments to the dividend payout? Because the less dividends they pay, the more cash they keep, makes their earnings look a little bit better. But so many investors rely on dividends for that extra income, and we usually reinvest it back in the stocks that we buy or in the overall market, which gives us a little more buying power every time we invest. So keep a close eye on dividends this week. A huge and very busy week right now in front of investors. This is the Investopedia Express live from the New York Stock Exchange. We are going to put this on all the streaming platforms, your favorite podcast platforms following the show. But we want your comments. We love hearing from you folks. So tune in and drop in this week. Hey, Margaret Jackson loves dividends. We love dividends too. That's why we want you to keep a close eye on them. Hey, and we're getting some more questions here. Asher is asking, which stock is the best to invest in for beginners, the lowest price or the higher capital? Oh, price is only relevant in perspective. What was the price a few months ago? What's the price today? You want to buy stocks based on whether you think these companies are going to continue to grow their profits. Main reason for owning stocks is because you think that these companies are going to continue to grow their profits over time. And the stock market is a discounting mechanism for future profits. As companies grow their profits, companies like Nvidia, well, they usually return that money to shareholders in the form of a higher share price or dividends. So you don't need a lot of money to buy stocks. You can buy them fractionally by the dollar amount. So don't worry too much about the price. Worry about the trend. Erdem says they expect new records in the indexes in the near future. I don't think you're crazy. Record highs usually beget more record highs. Taha host has asking us, do we expect more US dollar devaluation this year? Year to date, it's down 13% against the euro. It's down against other major currencies. That may be by design. This administration might actually want a weaker dollar. Why? because 40% of the profits made by the S&P 500 companies come from overseas. A lower dollar juices their sales. So if we're throwing tariffs on just about every country we do business with, weaker dollar actually spurs sales for the companies that are based in America selling overseas. How about the IPO return? Hey, we're starting to see some IPOs. We're starting to see them right here at the New York Stock Exchange. Circle, a company that is involved in stablecoins and digital currency, went public. The more you see record highs, the more you see a relaxation of regulations, the more IPOs you see, and we're probably going to see a lot more. That market has been dead for a very long time. Now the questions keep flowing in. Margaret's asking, it would be interesting to learn how copper industries are utilizing AI. I bet they would love to tell you. So if I were you, I would look in the earnings reports that are coming out from the Rio Tintos, the BHP Billotons, Southern copper companies of the world. I'm sure they'd be glad to tell you how much they're using AI, because any company that says they're using it for more productivity and profitability, they usually get a little boost to their share price. Hey, Colin, I can't wait to speak with you in the FPA this Wednesday as well. Colin Overweg, one of our friends and great financial advisors out there, puts together a great group of young certified financial advisors, and they are the future of this business. Hey, Mauro is asking, is it possible for an outsourcing servicing LLC to go public? What determines the IPO? Greetings from Paraguay. Mauro, you have asked me a question that I cannot answer with the knowledge I have in my head, but I'm going to look it up on Investopedia. And if you drop your email in the chat there, we will send you the answer. Hey, you want a history of me? Check out my bio on Investopedia. I am Caleb Silver, the editor-in-chief of Investopedia and your host for the Investopedia Express. It's time to get to work. Thanks so much for joining us. Big thanks to our friend Callie Cox. All the reports we cited this week will be in the show notes on your favorite podcast platform. Big time, boy. It is going to be a big week. We will talk to you a little further on down the line.